recording. I should say, how are you feeling about reviewing for this quiz?
I need to go over the last chapter, halfway done through with it, but overall, I think just with a little bit more practice, I think it'll make sense.
Okay, that's a good place to be on Thursday. Okay, so we'll start out with the budget question. So we want to figure out the dollar amount of electric stapler sales budgeted for March. So when we look at this, we're given information for December, and we're told that it's going to grow by 5% every month. So what we're going to do is we have to figure out, what does that mean to us? So we're going to start with, what are our current sales? So we know that, what do we know? Where's my pen? See a connection somewhere. There we go. There we go. All right, so we know that we're looking, we know what was sold in December. We sold 9,000 units in December. And we expect it to increase by 5% every single month. So we're going to look at this and we're going to say, okay, so we know that 5% is the same thing as 0.05, because I'm going to use that for multiplying. Also, if I want to figure out an increase, the shortest way to do it is to say, like, here's $9,000 times 1.05 tells me what a 5% increase would be. So in December, we just have to follow it through. We have $9,000 in sales, no, 9,000 units times 1.05. So in January, this is 9,420. So in January, we had 9,420 units sold times 1.05 gives us 9,922. So in February, we sold 9,922 times 1.05. So now we're getting down to the end. So here we sold 10,418 units. So in March, we sold 10,418 units. But we're not done, because it doesn't ask for the number of units, it asks for the dollar amount. So the last thing that we have to do is take our 10,418 units times the selling price, which is $12.15 equals, I have 1265, but I want to make sure I'm not missing it under our people. Yeah, that's what I thought. 126,578.70. Can't write tonight. All right, does this one make sense?
How do you get the 1.05 again? Sorry.
So I could say what you would have done probably is 9,000 times 0.5 tells me 420, and then added it to the 9,000, right? Or I can say 9,000, if it's a 5% increase, one says, okay, everything that we've already done plus 0.5 plus 5%. So when I multiply 9,000 times 1.05, I get the 9,000 plus an additional 5%, which is 420. Does that make sense?
So if I do it like on the calculator, 9,000 times 5%, it gives me 450.
Yeah, but you still got to add the initial
Oh,
amount because
this
it's
is
growing.
50.
Yeah, it's
No,
supposed to be
I
9
just read
for.
the number. I just read the number wrong.
So another way to do it, you could just do 9,000 times 5%.
And then add it to 9,000.
Okay,
Zero,
thank you.
5%.
But you need to know how to use a percentage increase. You're going to use that a lot, and you need to know that instead of doing 2 steps, you can multiply 9,000 times 1.05 and get 105%.
So the full amount plus the
Mhm.
0.5% that is supposed to be. That's
Exactly.
easy, right? And it's
It
faster.
is. It's easier. The fewer calculations, the less chance there is for mistakes. But you should just know that it works that way, that the numbers work that way.
Thank you.
You're welcome. Oops, Liz, you stopped writing and I thought you were done. I'm sorry if I just erased it while you were writing. Okay. Okay, number 3 or number 2 is the same as number 1, just with different numbers. So there's 2 questions like that. All right, question 3. Also a budget question. So it looks like a ton of information, right? But once we dissect the information, it's not as bad as it looks. So the first thing that you want to do is you want to figure out, what am I being asked? And think about, what do I need to figure that out? So we want to know the budgeted materials needed in kilograms. So we want to know, how much materials do we need for the entire first quarter? So if you remember, so we're going to have a sporting goods manufacturer budgets production of 57,000 pairs of ski boots in the first quarter and 46,000 pairs in the second quarter. So 57,000 in the first quarter, 46,000 in the second quarter. Each pair of boots requires 3 kilograms of a raw material. The company aims to end each quarter with ending raw materials inventory of 25% of the following quarter. For this material, beginning inventory for this material is 33,000. All right, so we're just going to use our formula. So we know we have quarter 1, and we have to figure out quarter 2, because we have to know from quarter 2 what our needs are. So for quarter 1, we're going to take our production, which is 57,000 pairs of boots, times how much product is required for each one, so times 3 kilograms, because we're looking at not how many pairs of boots, but how much material. So we know that we need 171,000 kilograms for quarter 1, just the 57,000 boots. We also need ending inventory for the next period. Okay, now the problem is that we're given the number of pairs of boots, but we're not given the quantity of product that we need. So we have to figure that out to know what 25% of it is. So in quarter 2, we have 46,000 boots times the 3 kilograms. So we're going to need 138,000 kilograms just for that month's sales. We want 25% of it to be in ending inventory. So we want 34,500 in ending inventory. So in quarter one, we need 171,000 kilograms just to make our 57,000 pairs that we're going to sell. Plus, we want to end up with 34,500 kilograms left over so that we start quarter two with the 34,500 kilograms. We already have in beginning inventory 33,000. So we don't need to buy that because we have that. So we need for quarter one, 172,500 kilograms. A lot of information in these budget problems. Okay.
Question, Doc.
Mm-hmm.
So it's saying beginning inventory for the material is 33,000 kilograms.
Right.
But it doesn't, where does it state that it's in the first quarter that's where the beginning inventory is at?
Because that's what we're trying to figure out. We're looking at quarter one and quarter two. So beginning inventory would have to be quarter one because we aren't to quarter two yet. We're budgeting for the first quarter.
Tracking.
All right. So not so bad if you just think it through. All right, question number 4. We're actually not going to use some of this information, so it looks worse than it is. So the first thing we want to do is figure out, what are we trying to figure out? We want to know the budgeted purchases of a product for the year is what we're looking for. So we want to know how much of this product are we going to have to buy for the year. Okay, the sales budget from Modesto Corp shows that 20,000 units of product A and 24,000 units of product B are going to be sold for $11 and $13 respectively. The desired ending inventory of product A is 10% higher than its beginning inventory of 3,100 units. The beginning inventory of product B is 3,600 units. The desired ending inventory of product B is 4,100. Budgeted purchases of product A, we're only looking at product A. So the first thing we can do is say, okay, this doesn't matter because it's product B. Also, we're looking at budgeted purchases, not dollars. We're looking at units of purchases. So the dollar amounts actually don't matter. So when we get rid of B, now we're left with what matters. Okay, so we know that we have 20,000 units. We know that desired ending inventory of product A is 10% higher than its beginning inventory. So ending inventory, our beginning inventory is 3,100 units. So 3,100 units times its 10% higher, 1.10, is 3,410 units. So my ending inventory is going to be 3,410 units. So now I'm going to use, I know that I'm going to sell 20,000 units. Because it shows that we sold 20,000 units of product A. I'm going to sell 20,000 units. I had in ending inventory an additional 3,410 units. I'm going to take out what was in the beginning inventory, 3,100 units, which means that my budgeted purchases of product A was 20,310 units. This is for production. So we have to plan for the units that we're going to sell plus the ending inventory, and we don't have to do what we already have in beginning inventory. All right, are we good here? You guys are quiet tonight.
Yes.
Yeah, good, Doc.
All right, number 5. Same thing. So here we're figuring out the budgeted materials needed in pounds for January. So when we do this, we know that we're going to need January and February. So we're looking for the budgeted materials needed in pounds for January. So all right, Alliance's company's budgets production of 22,000 units in January. So January, 22,000 units, and 26,000 in February. Each finished unit requires 5 pounds of raw materials that cost $3.50 per pound, which we don't have to worry about the cost because we're looking for pounds, not cost. Each month's ending raw materials inventory should equal 30% of the following month's budgeted materials. And our beginning inventory is 25,000 pounds. So we're going to start with, in January, we need to produce 22,000 units. And in February, we need to produce 26,000 units. And each unit requires 5 pounds of material. So for January's production, I'm going to need 110,000 pounds. And for February's production, I'm going to need 130,000 pounds. So I need to know how much I need in ending inventory for January. So I know that I need 30% in ending inventory. So I'm going to take the 130,000 times 30%, and I see, okay, I'm going to need 39,000 pounds in ending inventory. I already have in beginning inventory 25,000 pounds. So I need 124,000 pounds in January. Does it start to look familiar?
Yeah.
All right, we're going to switch gears a tiny bit. We're going to figure out the total budgeted overhead. This should be easier for you. There's just one little trick in this one. So Flagstaff Company has budgeted production units for July of 10,000 units. Write that down. So we have production is 10,000 units. Variable factory overhead is $1.50 per unit. Budgeted fixed factory overhead is 30,000. Which includes 5,000 of depreciation on the equipment. So the first question is equipment depreciation an overhead cost? reach back, is depreciation on the office equipment and overhead cost.
No, not office, but it's saying factory
Off on
equipment.
the factory equipment. Did
Yeah,
I say
it-
office? I meant factory. Yes. So
Yes.
you have to know to include depreciation. Just don't do anything weird like subtract it. Compute the total budgeted overhead to be reported on the factory overhead budget for the month. So this is simple. All we have to do is add the variable and the fixed overhead together. So variable factory overhead is 10,000 times $1.50, which equals 15,000. And fixed factory overhead is 30,000. So total is 45,000. See, that one was easier, wasn't it?
Yes, it was.
Kind of.
Kind of, yeah. I know, it's not because it's different. You have to switch gears.
But did we not include depreciation with our final answer of 45,000?
Yeah, you do want to include depreciation.
Because
Yeah,
it's
I think I missed
factory.
it though.
What?
I think I missed where we did include depreciation in the
Oh,
formula.
they give it, they say the fixed factory overhead is 30,000, which includes 5,000 to factory overhead. So we
Oh,
simply
okay.
didn't deduct it.
Got it, got it. Okay,
Okay.
thanks.
Okay, now we're going to figure out selling expenses for February. Not that different than when we did materials. So we want selling expenses, actually it's easier, for February. So Webster Company's budget for sales for February are 350,000. So that's what we think sales will be. Webster pays sales representatives a commission of 10% of sales dollars. A company pays a sales manager a salary of 6,000 and expects advertising expense of 3,000. So the first thing you have to know is, do you include advertising expense and selling expenses?
Yes, you do.
You do. So we have our sales of 350,000 times our 10% commission. So the commission is 35,000. Plus we have our salary of 6,000. Plus we have our advertising of 3,000. So our total selling expenses are 44,000. Much easier. All right, the next one's a little bit more complicated. Because we're looking at cash receipts. So let's get really clear on how we collect our cash receipts. So a company's history indicates that 25% of its sales are for cash. So cash is 25%, which means that credit is 75%. Collections on credit sales are 25% in the month of the sale. %40 in the next month, 5% in the following month, and 5% is uncollectible. We don't have to do anything with that. There's nothing to do with it. It's uncollectible. We have sales projections for December, January, and February of 65,000, 90,000, and 100,000. And we want to know the February expected cash receipts from all current and prior credit sales. So we know that in December, we're selling 65,000. In January, we're selling 90,000. And in February, we're selling 100,000. Okay, so so we can look at it this way. So from our December sales, current and prior sales, I wrote this wrong then.
Start off with the cash receipts, right? The 25%.
Projected sales for December, January, and February. Okay, so for December, I don't have my phone here, it died. I need a calculator. Hold on, I'm going to pull up the calculator. There we go. Come on. For December, we had 65,000 in sales, 75% was on credit, which equals $48,750. So in February, that is 2 months after. So we're going to take the 48,750. So we're going to say we're going to collect in February 5% of December. So for December, we have 48,750 times 5% is $2,437.50. Okay, now in January, we have 90,000 times 75%. So 90,000 times 75% is 67,500. So that's the 1 month after in February. So for January, we're going to collect 67,500 times 40%. Or $27,000. And now in February, in the month of the sale, it's going to get a little bit more complicated, because in February, in the month of the sale, so automatically 75% of it is on credit. But we're concerned with the cash receipts in February. So in February, 25% of this is cash. So the first thing we have in February is the 100,000 times 25%, which is 25,000. And then we have the second part. So 75,000 was on credit, which equals $75,000 on credit. We collected 25% of that in the month of the sale. So we also have 75,000 on credit times 25% for the month of the sale. Or 18,750. So in February, we collected 5% left over from December. That's all we'll ever collect for December. We're done. We collected $27,000 from January sales. We collected $25,000 in cash sales for February. And we collected $18,750 of what we sold on credit during that month. So our total is $73,187.50 for February. All right, so the important thing is to line up the data, make sure you know what you're doing and do it step by step. For example, I'm looking at one that I worked and I forgot that in the 65,000, that's their total sales. That's not just the receivable. That I have to reduce that to just the receivable. Because I'm not going to collect the cash part of the sale 2 months later. All right, how do you feel about this?
Good. It just required some thinking, and then I like how you did the top left and top right corner. You set it up way easier than I did.
Okay, and that's why I like doing this, because you can see how I approach it. I like to pull out the data because as long as I'm hunting and pecking through the words, I'm liable to make a mistake. Plus, when I pull out the data, I'm getting a firm picture in my head of what's happening. Okay, the next one's easier. We just want to know the cash balance. All we're doing is cash balance, and we don't even have a lot of information we have to hunt and peck through. So we know we want the cash balance at the end of August, not counting any loan activity. So Southland Company is preparing a cash budget for August. The company has $17,000 cash at the beginning of August. Okay, so for starters, we have $17,000 in cash and anticipates $150,000 in cash receipts. So we're going to add the $150,000 in cash receipts and $130,000 in cash disbursements. So we're going to subtract that. Southland Company wants to maintain a minimum cash balance of $10,000. Okay, that doesn't really matter because we're figuring out what is our balance, and our balance is $37,000. Told you that was easy. The words probably made it look harder than it is. All right, now we're going to look at variance analysis. So number 10 is variance analysis. We want to know the total direct materials cost variance. So that's the total variance. So what we want to do is we want to figure out, okay, standard, remember this means our budget, right? And then these are actual. We want to know the cost variance. So we know that the direct materials the direct materials cost us $800,000. This was our budget amount. We actually spent $902,000. So our actual, they give us our numbers, is $902,000. And we wanted it, we planned in our budget for it to be 800,000. So the variance is 102,000, but we're not done until we say whether it's favorable or unfavorable. So is it favorable or unfavorable?
It's unfavorable
It's unfavorable.
because we spent more than the budget.
We spent more than we planned.
Yeah.
And the reason we're looking at the total one is because this is the total. So we're not worried about, we're looking in total. It doesn't matter that if we were separating it into efficiency and price, then we would be more concerned with that we use more materials, but we paid more for them. Okay. Budgeted sales. We want to know the sales that are expected if the company produces and sells 18,000 units. But what we're doing is we're going from a budgeted number of 15,000 units. We did a flexible budget for 15,000 units, but we actually produced and sold 18. So what we want to do is we want to figure out if our budget is for 15,000 units, but we sold 18,000 units, we want to take our, and you would, now we get to do this in Excel, but we want to go from the numbers for 15,000 units to what the numbers would be for 18,000 units so that our budget is comparable to actual. Otherwise, it's not comparable. So we know that showed sales of 120,000. So we have sales 120,000 when it's 15,000 units. Variable costs of 70,000 in our 15,000 unit budget, and fixed cost of 15,000. So if we sell 18,000 units, we want to know how to adjust all of these numbers. So what we're going to do is we're going to say, okay, we have 120 units, $120,000 in sales.
Well, do we really need the variable cost and fixed cost? If we're just trying to get the
Nope, we don't. We're going to take, you're right, we're going to take the $120,000 in sales divided by 15,000, you're right, we don't, divided by 15,000 units. So the sales price is $8 per unit. So we're going to take 18,000 units times $8 per unit is 144,000.
Now we would utilize the variable.
Right, we don't need this here.
We would use that if they were asking how much it costs.
Yep.
Correct. Okay.
Or the profit,
Or the profit. Okay.
or the contribution margin, yeah.
Sounds good.
All right, we're gonna do another variance one. Nope, budgeted fixed and variable overhead. Wait, oh. Because I haven't switched it, there we go. Yeah, that's right. How can it look different on my screen? That's so funny. So we wanna know the actual cost of, well, no, we know the actual, Georgia, the actual cost of direct materials used is, so we want to figure out the actual cost. What we're given is how much they use. So we use $4 per finished unit. That's our budget. That's what we plan to use because it says standard. We have a $20,000 unfavorable cost variance. And then they tell us actual use. We actually don't need that. We need, so our budgeted is $4 per unit.
Did we skip 12? I'm sorry.
Did I?
Yeah, I think we skipped
I'll go
12.
back in just a minute. Times 30. Times 30,000 units. I actually finished 30,000 units. So $4 per unit times 30,000 units. I plan to spend $120,000. If I have a $20,000 unfavorable variance, does that mean I spent more or less than $120,000?
You spent more.
I spent more. So I'm going to take my unfavorable variance and I'm going to add it because I spent more. So I actually spent $140,000. I plan to spend $120,000. Oh, they're just numbered wrong. Because that's why I was confused switching slides. Because when I go back to the one right before it, let me clear my writing so it's not confusing to you guys. So we did this one with the 15,000 to 18,000 units, right? And then the next slide, so I just got off of my numbers, is that's 15 to 18. Oh, that's weird. Okay, you're right, let's work this one. We want to know the budgeted amount of fixed and variable costs for 15,000 units. Oh, this is the other one with, now we need the fixed and variable costs. So we are going from 13,000 units with operating income of 30,000 after deducting variable cost and 70,000 of fixed costs. Based on a predicted level of production and sales of 13,000 units, the company anticipates reporting operating income of 30,000 after deducting variable costs of 70,000 and fixed costs of 10,000. based on this information, the budgeted amount of fixed and variable cost for 15,000 units would be what? Okay, so we have 13,000 units. And we're going to go to 15,000 units. So we want to know what is the new amount for fixed and variable costs. So for our variable costs, there's 70,000. So we're going to take our variable cost and we have to figure out how much it is per unit. So our variable cost, if we made 13,000 units and cost $70,000, is
2.31.
thank you, $2.31 per unit. So for 15,000 units, so here it's 70,000. Here I'm going to take 15,000 units times $2.31, which equals what?
Oh, hey, you know what, Doc? I'm sorry, I looked at the wrong number. I divided the net income instead of the 70,000.
Oh,
So
gotcha.
I'm sorry. Let me.
That's okay. That's all right. Actually, I got it.
70,000 divided by.
That's good because I thought it was low and then I thought it must be me.
So it's 5.38. So 70,000 divided by 1,300 or 13,000 is 5.38 rounded. Yeah.
The other one is 80,700.
80,700. So we went from 70,000 to 80,700. Fixed costs, if we did 13,000 units, is $10,000. Well, because it's fixed, it's still going to be $10,000. Making sure we answer the question. So our budgeted fixed and variable costs would be $90,700. Or if they want them separately, $80,700 and $10,000.
Yeah. See, that's why I take my time on the test, because I always like catch something that I look at wrong.
Look, you guys, when
Yeah.
I told you this, I think, in the last class, but when I was in graduate school, we did everything, and we had group projects in every class, and we had the same group that we stayed together the whole time. So I mean, we depended on each other, right? They were my school family, for better or for worse. So I didn't have to take financial accounting for obvious reasons. I did have to take this class for reasons that are not obvious to me, but I didn't have to take financial accounting, but they did. And so first of all, you all know it's really challenging to learn. So they really did learn. I mean, I didn't do it for them. We met together as a group many times each week, and I had a huge whiteboard, and we learned accounting. That was long before I thought about doing it this way. We could have all sat in our living rooms in our pajamas. What was wrong with me? So we did it. Wait, I don't think this existed then. So they did learn it, but when we did the final exam, I mean, I wrote everything out in the margins just to make sure. I mean, the way I would have done it when I was an undergrad student taking the class for the first time. It's like I didn't want to miss anything or make any careless mistake. And that was, I mean, I was a CPA taking a financial accounting exam that 3 other people's grades were relying on. I wasn't going to make a mistake. So I did the same thing, very slow, very methodical. Check it 3 different times. We just did that one. Okay. I get it. Good way to go. Okay, so we want to know the total labor cost variance. So a job was budgeted to require 2 hours of labor at $11.25 per hour. So the budget was 2 hours at $11.25 an hour. The job consisted of 9,500 units and was completed in 17,000 hours at a total labor cost of $190,000. Okay, so what do we know? We know that our budgeted cost, because that's all we're looking at, is $11.25 per hour. Our actual cost was $190,000 divided by 17,000 hours. So our actual cost was $11.18 per hour. So if we plan to spend 11, what is wrong with me? 25 is our budget. And we did spend we have a difference of 7 cents per hour. Now we want to say, well, how many hours did we use? We used 17,000 hours. So our total variance was 1,190. Now, is that a favorable or an unfavorable variance?
Favorable.
It's favorable.
Right, because we plan to spend $11.25 per hour and we only spent $11.18, so it's a favorable variance. I like your cup, Liz. Oh, what does it say? I'm crap. Hold on 1 second. Live for the moment. You can't, oh, you can't put into words. I love that saying. I do love that saying. It's so true too. But my daughter hates all this.
Yeah.
She says I'm spending, and I don't even go on Facebook hardly ever. And she says I'm just spending too much time on Facebook. Those are like, what does she call them? White mom Facebook sayings. I mean, what is that? And the rest of the time, if you even say, oh, look, that's a black cat, she's like, that's racist. What is white mom Facebook sayings? Oh gosh. It's so true though. Not that, the part about the moments you can't put into words. Okay, now we want to do the actual direct materials cost for the current period. So this is one of those where we're given the budgeted cost and we're given the variance. So we want to figure out, we're looking at total, the total cost difference. So Sanchez Company's output for the current period was assigned a $400,000 standard direct materials cost. So our budget, right, was $400,000 for direct materials. That's what we planned. We want to figure out what did we actually spend. The direct materials variance includes a $10,000 favorable variance and a $7,000 unfavorable quantity variance. So our price variance is favorable. So if we had planned to spend 400,000 and we have a favorable variance, we want to subtract it because that means we actually spent less. So our favorable price variance.
Doc, it's asking for the actual total direct materials
cost, right. We plan to spend 400,000. We're trying to figure out what did we actually spend. So we plan to spend 400,000. We know that we have two variances. We have a $10,000 favorable price variance and a $7,000 unfavorable quantity variance. So we plan to spend $400,000. Total. We plan to spend $400,000. We have a $10,000 favorable variance. So we actually spent $10,000 less than we planned price-wise. But we have an unfavorable quantity variance. So as far as quantity is concerned, we spent $7,000 too much. We spent $7,000 more than we had planned to. So in total, we actually spent $397,000. Does that make sense?
Wait, so am I missing something? Because so when it's asking for the total, wouldn't it, they've already given us the favorable and unfavorable. So wouldn't it be favorable 3,000 for total direct materials?
Well, you would, okay. It is, so yes, you have a net favorable variance of $3,000. That part's right. So look at it this way then. We know that. We have a favorable variance of $3,000. If we plan to spend $400,000 and we have a $3,000 favorable variance, that means we actually spent $3,000 less, right?
100.
So we're going to subtract that. Does that make sense? That's how we got the 397,000.
Okay, so hold on, I'm trying to pull it up. I think I just give me 1 minute. I'm sorry.
Okay, it's okay. That's the whole purpose of this.
Okay, no, see, I understand what you did there. It's just what I'm asking. What is the actual total? Okay, never
The
mind.
400 was the budget. Now we're
Okay, you know what? So I'm doing the calculation and the formula at the end. So I thought it was the difference because I saw total, so it threw me for a loop. Not necessarily the actual direct material cost. I was actually looking
okay.
at the total.
Are you better now?
Yeah.
Okay. All right, this looks like tons of information. But it's not bad actually. So Fletcher Company collected the following data regarding production of one of its products. We want to compute the fixed overhead cost variance. So we're looking for the fixed overhead cost variance. All right, so we know the actual cost of fixed overhead was 500,000. So this is actual. They give it to us. So we need to figure out what's our budget, what's our budgeted cost. So we have direct labor hours, actual direct labor hours, budgeted units, actual finished units. So we're going to need these. Standard variable overhead rate. Okay, so standard, we have our standard variable overhead rate and our standard fixed overhead rate. We're only worried about fixed overhead. So this is the only one that we're worried about. So our fixed overhead rate, we know, is $9.20 per unit. Okay, so we have to figure out how much we actually spent, or what our budget was. We actually spent 500,000. So our budget we plan to spend $9.20 a unit, right? And we actually did 46,500 units, which means that our budgeted amount was 427,800. So now we can compare the two. Now we can say, okay, our actual overhead was the $500,000 that was given to us. Our budget was 427,800. So our variance is 72,200. And is it favorable or unfavorable?
Unfavorable.
Unfavorable. Actual budget, right.
Real quick question. How come we aren't multiplying it by the budgeted units and instead we're using the actual finished units produced if we're looking for the budget?
Because we're figuring out the cost variance. So you have to isolate the cost. So it's the actual units times the budgeted rate compared to the actual units times the actual rate.
Got it. Okay. And that's reflected in the formula too, right? That
Yep.
Spreadsheet. Cool.
Yep. This is the left-hand side of the spreadsheet.
Got it. Thank you.
All right, we're going to figure out here the price variance. So we want to know now the price variance. So Claremont Company specializes in selling refurbished copiers. During the month, the company sold 150 copiers for total sales of 375,000. That's actual. The budget for the month was 160 copiers at an average price of $3,000 each. So if we take our actual we get the 375,000 because actual is 375,000. They're given to us. To figure out the budget, we're going to say, okay, we're going to take our actual sales times the budgeted price. So we have $3,000 each times 160 copiers is 450,000. So now we can just, so this is budget and this is actual, because we've isolated the price. So now we can say, okay, our budget was 450,000. Actual was 375,000. So we have a $75,000 variance. And is that favorable or unfavorable?
Favorable. Favorable?
I'm looking to see, why do I have unfavorable here?
Oh, actually, no, because it's income. So that's
Because
why
it's income, right?
Yeah, yeah.
Yeah, you guys go slowly on this quiz. Take a break when you take this quiz.
Yeah, I haven't had time to study as much as I want. So Friday and Saturday will be that.
And then it's just really, I think this is one of those tests that it's important to be refreshed as possible when you're taking it. Not that that's ever necessarily possible. And mentally tuned in. So if something's interfering with taking it this weekend, let me know. Emotional upheaval counts. It happens to everyone. Some people wish it was happening to them. Question 18. We want to know the departmental delivery expenses for Y and Z respectively. So we're just looking for the total expenses. So we know that we're going to figure it out for Y and for Z. Okay, the company has two departments, Y and Z, that incur delivery expenses. An analysis of the total delivery expense of $14,000 indicates that Department Y has a direct expense of $1,500 and Department Z had no direct expense. Okay. So direct expense, $1,500, and Z has no direct expense. The indirect expenses are $12,500. An analysis indicates that 50% of regular delivery requests originate in Y and 50% in Z. So we have indirect, and since they both have 50%, I can say 12,500 times 50%. So we have 6,250 and 6,250. So Department Y's delivery expense would be 7,750, and Department Z's delivery expense would be 6,250. See, there are some easy parts. Oh, the next one's easy. Did I just erase that while you were writing it down, Liz? Oh, good. I was going to have to apologize again. Okay, 19. Compute the division's return on investment. So here, all we have to do is put in a formula. The formula for return on investment is sales minus cost of goods sold minus operating expenses divided by average total assets. So there's a lot of numbers to plug in. So Holo Company reported the following financial numbers for one of its divisions for the year. Average total assets of $6 million. So we have, what the heck? Fine, I'll go with that. 6 million. Sales of 5,800,000. cost of goods sold of 3 million, and operating expenses of 1 million. So first of all, we have 1,800,000 in the numerator and 6 million in the denominator. So that's 0.3 or 30%. Ooh, the next one's easy too. This is just profit margin. So profit margin is just income divided by sales. By the way, I think the ratios are in the back of your textbook. So average invested assets are 650,000. That's nice, we don't care. Sales of 1 million. So we'll put 1 million on the bottom. And income of 150,000. So we'll put that on the top. So it's 0.15 or more appropriately, 15%. Next one is another return on investment. So I just gave you the formula again. I think the data was long. You also have to be able to calculate, okay, allocated salaries. So you're going to be doing allocations for a very long time for a lot of different ways. So there's too much data for me to put it on here, but what you're doing is you're going to take, like, if it was for a specific department, and we've done this before in a lot of other circumstances, you would take the, like, the number in department A divided by the total number, gives you the percent to allocate to A. So if it was baking department or mixing department, it doesn't matter. You're going to take that department's numbers divided by the total to get the percent to allocate.
Yeah, and then that's when we multiply it to the total salaries, correct?
Yes.
Okay.
That's how you know how to allocate it to, like, department A or department B. And we're actually going to do it here in a different situation. So here, what we want to do is we want to, administration is allocated based on the workers in each department. Maintenance is allocated based on square footage. The amount of administration expenses, it should be allocated to the assembly department. So we want to allocate the admin expenses to the assembly department for the current period. So administration is allocated based on the number of workers. So assembly and painting. Assembly has 250 employees. So we know assembly has 250 employees and occupies 50,400 square feet, which we don't care about right now. Painting has 50 employees. So we have total 300 employees. The total. So we want to allocate the cost to the assembly department. So what we're going to do is we're going to say, okay, we have $90,000 to allocate times The assembly is 250 employees out of 300. So we're going to give the assembly department $75,000 worth of the costs. That makes sense?
Yeah, sorry.
That's okay.
Yes.
I assumed you were writing. That's fine. I didn't think you were sleeping.
No, I thought I clicked on the mic.
Oh, I hope I don't put you guys to sleep. Okay, we want to do the contribution to overhead as a percent of sales. Oh, good. Thank you for the note. Ultimate Company operates 3 production departments as profit centers. So Department 1, Department 2, and Department 3. Department 1's contribution to overhead as a percent of sales is, so we want to figure out contribution to overhead as a percent of sales for Department 1. So we're only concerned about what's happening with Department 1. So we have sales, cost of goods sold, direct expenses, and indirect expenses. And we want to know their contribution to overhead as a percent of sales. So we're going to we have to figure out what is overhead. So we know sales minus cost of goods sold minus direct expenses equals overhead. So we have 1,200,000 in sales minus 720,000 in cost of goods sold minus 120,000 in direct expenses. Okay, that's good. Equals 360,000 for overhead. So now I can do my formula. So my formula is overhead divided by sales, because I want to know what overhead is as a percentage of sales. So I'm going to put overhead on the top and sales on the bottom. So my overhead is 360,000 and my sales are 1,200,000, which is 0.3 or 30%. Thank you. Make sense? And here's the really, yep. And here's the really odd thing. I have no idea what this last slide is. Weird. Okay, a lumber mill, I have to think now. A lumber mill bought a shipment of logs for 57,000. So we paid 57,000 for the logs. When cut, the logs produced 1 million board feet of lumber in the following grades. So we have type 1, type 2, and type 3. Compute the cost to be allocated to type 1 and type 2 respectively. Oh, I know why, because I deleted this from the test. That's why I deleted it from the test. That's why I didn't do it.
We're not doing this one?
Nope. You're not going to use this. So I just deleted this one on the test. Yay, right?
Okay, so I'm not even gonna work on it. I'm taking
No, don't even work on it. Okay.
Was 21 the same as 20?
No.
Yeah, it was.
Thank you.
Oh yeah, it was. Okay, thank you. All right, how do you feel about this one?
I feel good. I need to work a little bit. I haven't created my formula sheet and I haven't done the assignments yet. I just been super busy this week, checking out for the retirement. So,
Well,
but
this is
for
a,
the most part,
wow, congratulations.
thank you.
This is it's a good, you're in a good place for Thursday. Okay, so I know that this is Memorial Day weekend. If something happens, or if you're doing something, I know most people aren't because nothing's open unless you live in a few states that have it open. Is Japan shut down? Oh yeah, you are. Are you shut down, Liz? You're not?
Yes, we are.
Oh, you are? Yeah, it's so weird.
So
There's what?
I'm sorry, I can hear you very well.
Yeah. Now I can't.
What did you say?
So if you need extra time, if something's going on, please reach out and let me know. Okay? I can't help you if I don't know what's going on. You're in New Orleans. Yeah, it's open for you. If
I
you're
got
in-
a question about the homework. Like
Okay.
I'm struggling a lot with the last part of the overhead, like the controllable variance thing. So maybe I'm gonna call you.
You are welcome. Well, we've
Controllable
talked
variance.
before. Yeah, we've talked before. And I actually took tomorrow off work, so I'm around all day planting.
Doc, if you guys do something like that, can you guys like Zoom like an individual one and maybe like record it and just put it in an announcement, just in case?
I can do that if that's okay with Liz.
Yeah, if it's okay with her, obviously. Because
I'm
if it's a
gonna charge.
question,
That makes sense. We're gonna put it on one of those pay sites. I'm not sure how to do that. But we'll figure it out. I know we can just throw it on one of those cheap websites. He's like, how much are you gonna charge? It's okay with me.
So I did the overhead, and when I got to the controllable variance, I was like, okay. So it's just
Okay,
like
why
I
don't you
blocked.
call me tomorrow and we'll look at it together. We can record it and post it.
Okay.
I
yeah,
forget, do
if
you
you're
call me,
okay with it.
do you call me in the afternoon? That's what you do, right? By afternoon?
Yeah, right now it's 7:20. No, it's 11:22 a.m. for me.
Oh, we're
So-
almost reversed. That's why it works. Yeah, because it's 10:22 p.m. for me. So you're 11 hours earlier than me. Well, unless it's the next day.
So you're on your 96 right now.
Yeah, so you usually call me in my afternoon. Well, it doesn't matter. Just call me whenever. That's it, I'm awake.
Around what
You-
time? Around what?
I don't know. You've always been. I'm home all day. I'm gonna have my phone with me. You all, whatever you normally do has always worked. I just
Okay.
can't remember if you talk to me in the morning or the afternoon, but whatever you normally do has always worked. So just do whatever you normally do.
Mhm.
I don't normally have to worry about preferred time because I don't like to get up first thing in the morning, although, I mean, I have to be at work by 9, obviously. But because a lot of you are in California, it's different. You're 3 hours behind me. You never call me too early. What you do have to pay attention to if you're going to call me is that by, like if you sit down at 9 o'clock to work on your schoolwork, which is, a completely normal time probably for a lot of people to work on it, it's already midnight here. So what you do have to be aware of is that you have to call me earlier. So like if you're working, you might plan on, if you get stuck, calling me on, Saturday morning your time. So that's the only thing that you have to be aware of. And you can still text me. I mean, if I'm awake, I'll help you. I won't be awake at midnight and in shape to help you. But I mean, if it was 11, I might be awake. So, I mean, you can text me first. It doesn't matter. Okay.
Maybe tomorrow at 8 p.m. You're 8 p.m. Is that
Fine.
okay?
Yes, totally fine. Yep, that's great. All right. Yep, that works just fine. Anytime. I'm going to be home. I'm not going anywhere because nothing is open yet. Something's open on Monday. I think I can get my daughter's braces tightened. So, All right, I will see you guys. I'll post the video in the morning. I will see you guys on Tuesday, and have good luck on the test and enjoy your Memorial Day if you get to go out and do anything.
Thank you. You too.
You're welcome. Bye-bye.
Bye.